All right, let's jump right into this explainer. Today, we are absolutely decoding the unspoken rules of wealth building. You know, the kind of real-world math that traditional schooling just completely glossed over or literally never taught you. Especially in today's wild economic climate, right? We're dealing with high inflation, absolutely crushing consumer debt, and an entire culture practically begging you to spend money you don't have. So understanding the actual financial survival skills that separate the quietly wealthy from the loudly broke, it has genuinely never been more critical. We're going to break down every single concept practically today. We'll look at detailed historical examples, true market returns, and the very real traps set up by the modern economy. My goal for you is simple. By the end of this, you'll have the exact blueprint to start building your own untouchable, quiet empire.
Okay, let's dive into this. Have you ever wondered why the people next door, the ones with the pristine, power-washed driveway, the brand new luxury SUVs, the designer clothes, why are they so often completely maxed out behind closed doors? It's the grand illusion of the modern middle-class lifestyle. Frankly, we are living in the era of the quietly broke. Think about a household earning, say, a fantastic salary of $150,000 a year. On paper, they should be wealthy. Absolutely crushing it. But in reality, they're often living paycheck to paycheck. Why? Because they're completely chained to $1,200 auto loans, maxed out credit limits, and zero-down luxury purchases. They are aggressively leveraging their future, literally borrowing from their future selves just to project this aura of absolute luxury to the outside world today. But in this explainer, we're stripping away that illusion entirely.
Now you might be wondering, what does that illusion actually cost? Well, here is a truly mind-blowing number, $1.3 million. That is the staggering hidden reality. It's the actual long-term cost of a standard $2,400 monthly mortgage stretched over 30 years. You have to ask, how does a normal, everyday house cost that much money? It all comes down to a little trick banks use called amortization. See, when you get a mortgage, the interest is massively front-loaded. It's like a giant puzzle where the bank immediately takes all the best pieces for themselves. For the first decade, your monthly payment is mostly just pure bank profit. You are barely making a dent in the principal balance of your actual home. Then, you add in relentless home maintenance, property taxes that keep creeping up, and the huge opportunity cost of all that capital being locked up in drywall and wood, and you quickly see how normal, incredibly hardworking people slowly go broke. They buy into this traditional American dream without ever realizing they've signed up for a multi-million-dollar financial anchor that strictly restricts their freedom for decades.
So, to untangle all of this, our blueprint today is structured like a video game where we level up step by step. We've got 4 areas. 1. The fake wealth illusion. 2. Avoiding middle-class traps. 3. The math of quiet wealth. And 4. Reaching silent millionaire status.
Let's eagerly step into level 1, the fake wealth illusion.
Now, what's really fascinating here is the stark contrast between these two completely different financial realities. It's night and day. On one side, you have the fake rich archetype. This is the guy who finances a $50,000 truck at a punishing 7% interest rate. He takes on a massive mortgage basically just to impress people he doesn't even really like. And here's the kicker. He possesses absolutely zero in liquid savings. If a medical emergency hits or the furnace blows up, he is completely devastated, financially ruined. Now, on the flip side, we have the quiet millionaire. This person pours their surplus cash into heavy dividend-paying investments. They drive a reliable, unassuming 10-year-old car, and they keep their mouth totally shut about their net worth. Here's a surprising fact for you. Most first-generation self-made millionaires never drive current-year cars. Never. The person in that boring, reliable vehicle is quietly winning the game of life, purely because they understand a fundamental truth. True wealth is strictly what you don't see.
And listen, this constant need to perform wealth, it leads directly to what we call the financial treadmill. I want you to literally picture yourself on a gym treadmill. You're running, you're sweating. Let's say you finally get that promotion and hit that magic 6-figure mark. Now, a generation ago, making more money simply meant you saved more money. Simple, right? But today, in the Instagram and TikTok era, the algorithm intuitively triggers this deep psychological urge to instantly upgrade your life. You get the raise, so you immediately upgrade your zip code. You finance a much nicer car. You completely overhaul your wardrobe. We call this lifestyle creep, and it's a financial disease. Because what happens is, your monthly expenses rise to meet or often completely exceed your brand new income. So despite making more money than you ever have in your entire life, your debt obligations are actually outpacing your salary. You remain financially stuck in the exact same place. You're just running faster, sweating more, and getting absolutely nowhere.
All right, we need to shift gears now to the boss battles of our financial video game. Section 2. Avoiding middle-class traps.
Let's look at a prime example of a trap that catches so many people, the brutal math of the $50,000 truck. Right now, everyday people are casually financing these massive luxury vehicles, but if we sit down and run the real, cold, hard math, almost no one can actually afford them. The true silent danger here isn't just the monthly payment, it's depreciation. It's a killer. The absolute second those brand new tires hit the public pavement outside the dealership, you instantly lose 10 to 20% of the vehicle's value. Poof, gone. Paying a bank's 7% interest to own a rapidly depreciating metal box isn't just a trap, it's practically a financial crime against your future self. When you factor in a 5-year loan, the insane insurance premiums, the gas, and that massive depreciation, you were bleeding hundreds of thousands of dollars in lost potential of your lifetime. Just imagine if instead you took that $800 monthly car payment and quietly invested it into a broad index fund every single month. The difference is literally life-changing.
And it gets even more intense when we perform a bit of a financial autopsy on the housing market. Buying a $500,000 house seems like the ultimate undeniable sign of success, right? But as we discussed with that sneaky amortization schedule earlier, for the first 10 years of a 30-year mortgage, you are mostly just paying the bank's interest. You aren't actually building meaningful equity. The upfront cost is astronomical, and the hidden costs, the endless roof repairs, the broken water heaters, the property taxes, they are severe. They completely trap your liquidity. Conversely, let's look at renting. Renting has a low upfront cost and very minimal hidden fees. If your fridge breaks, you don't write a $1,000 check. You just make a phone call to the landlord. If you rigorously rent and you take the difference in cost and invest it heavily into the market, it frees up your capital for massive high-growth potential. I know, it goes against absolutely everything we were taught growing up, but the strict math proves that renting and investing can mathematically build a much larger, much more liquid net worth.
Okay, let's move to Section 3 and see how this all actually builds, the math of quiet wealth.
To truly harness this, you absolutely have to grasp the snowball versus avalanche effect. Think of compound interest exactly like packing a tiny snowball and rolling it down a massive snow-covered hill. In the very beginning, it is agonizingly slow. It's frustrating. You look at your account and it feels like your money isn't growing at all. But historically, the S&P 500 averages a 7 to 10% return annually, and that's even after adjusting for inflation. So as your little snowball gathers those returns, it starts generating its own interest on top of the previous interest. It's making money on its money, and it gains incredible mass. Eventually, it aggressively multiplies your wealth into an unstoppable avalanche. If you take just $100 every single month invested, and this is the hard part, simply leave it alone for decades, the exponential curve at the end of that timeline will literally change your family tree forever.
So the crucial point I want you to take away is this massive wealth gap, $580,000. This brilliantly illustrates what's known as the 7-5-3-1 rule when you're investing just $300 a month. Listen to this. If you start investing that small amount at age 22, versus waiting until age 32 to get serious, that slight 10-year delay literally costs you over $500,000 in lost compounding power. Think about that. Time in the market is the ultimate cheat code. It's the ultimate multiplier. You literally cannot work hard enough in your 40s to beat someone who simply started investing earlier than you in their 20s.
So the next logical question is, where exactly should you put that money? Let's compare stocks versus real estate over a 30-year period. Now, I get it. Real estate is highly tangible. You can touch it, you can paint it, it's emotionally satisfying. But the historical data reveals that a broad, diversified portfolio of stocks definitively builds more silent wealth over time. And a massive, massive factor here is liquidity. Think about it. You can sell a stock portfolio in about 3 seconds on your phone from a beach anywhere in the world. Selling a house, that takes months of stressful inspections, staging the furniture, and paying huge closing costs to realtors. When you account for total instant liquidity, zero maintenance, no closing costs, and the absolute absence of property taxes, stocks pull ahead. Because at the end of the day, you are never ever going to get a call at 3 in the morning from an S&P 500 index fund complaining about a flooded basement.
But actually, wait, scratch that. It's not just about what you make. The real secret lies in the usable cash and fiercely protecting your wealth from silent killers. I'm talking about fees and taxes. Millions of people diligently max out traditional 401ks without realizing the brutal impact of high taxes waiting for them upon withdrawal. And we also absolutely have to talk about hidden management fees. A 1% management fee sounds totally harmless, right? 1% is nothing. But over 30 years, that fee doesn't just take 1% of your principal, it literally cannibalizes up to 25% or more of your total potential returns because it's stealing your compound growth. Now contrast this traditional setup with a Roth IRA. With a Roth, your contributions are post-tax, meaning you pay taxes on the income today, but your withdrawals completely 100% tax-free. It provides the absolute maximum usable cash when you actually retire. To put it simply, with a Roth, you're paying a small tax on the tiny seed today rather than paying a massive tax on the entire giant harvest tomorrow.
And that brings us to our final, most exciting level. Section 4, Reaching Silent Millionaire Status. Let's walk through the actual timeline of how this feels, both emotionally and practically, because it's a journey. Around age 25, just getting your first $10,000 together fiercely fights you. Every step is hard. You are scraping, you're sacrificing lattes. It's tough. By 35, you finally break the $100,000 barrier. As the legendary investor Charlie Munger famously said, the first $100,000 is a bitch, but it's absolutely crucial because it is the inflection point where compounding finally wakes up and starts doing the heavy lifting for you. By 45, you hit the $250,000 mark. And let me tell you, this provides incredible mental breathing room. The daily, grinding anxiety about money just starts to fade away. And by 55, you emerge as a silent millionaire. The undeniable truth of wealth building is that the first million absolutely hurts to build. It's a grind. But the second million, it feels almost completely effortless because your capital is now working so much harder than your physical labor ever could.
So how do we practically guarantee we get there? Here is the step-by-step lazy investor blueprint. And I emphasize lazy because you don't need to be staring at stock charts all day. Step 1. Save $20,000 in cash as an impenetrable emergency shield. Just park it in a high-yield savings account and leave it. Step 2. Aggressively wipe out all high-interest consumer debt so you stop bleeding your money to the banks. Step 3. Automate your monthly investments into broad index funds. Set it up so the money leaves your checking account the day you get paid so you never even have to log in or think about it. And Step 4. Tell absolutely no one. Do you know exactly why massive banks genuinely fear a person who has $20,000 saved and zero debt? Because modern consumer economies rely entirely on debt servicing fees and interest to survive. A person with a fully funded emergency shield has the ultimate leverage. They can say no to a bad boss. They can walk away from a toxic auto loan. They ignore predatory marketing. They simply cannot be manipulated.
And this brings us to the daily reality of the quiet wealthy. It's built on unsexy, boring, but incredibly simple habits. They drive highly reliable 10-year-old cars. They actively refuse lifestyle creep the absolute second they get a raise at work. They automate those small, consistent investments over decades, and they never panic check the stock market on their phones. They completely and utterly reject society's urge to look rich. They avoid those flashy real estate traps that drain their liquid cash. And above all else, they keep their net worth a complete and total secret. Keeping it a secret is so crucial because it actively insulates you from sudden lifestyle expectations, and it stops the inevitable loan requests from friends and family. These are the mundane, highly disciplined choices that permanently separate the true silent millionaires from the stressed out, completely fake rich.
So I want to leave you with one final provocative question. Think about the next couple of years. By 2026, which financial level will you choose to reach? Because you now have the absolute blueprint in your hands. The illusion of looking rich has been entirely shattered for you today. So it is now entirely up to you. Are you going to bravely step off that exhausting financial treadmill, rigorously apply these unsexy mathematical formulas, and start quietly building your own untouchable empire? Or are you going to keep running and sweating for the banks? The choice is entirely yours.
Thanks for watching. If this gave you a new way to think about your wealth, subscribe to Langford Invests. Leave a comment below with the one savings move you're making this year, and I'll see you in the next one.